Welcome to another episode of How It Works, where we break down complex concepts into easy-to-understand terms. Today, we're taking a closer look at the phenomenon of bank runs, a term you might have heard in relation to financial crises and economic downturns, including the most recent collapse of Silicon Valley Bank. In this video, we'll explore the underlying causes, mechanics, and consequences of bank runs, as well as measures taken to prevent them. Before we delve into bank runs, let's begin with a brief overview of the banking system. Banks serve as intermediaries between savers and borrowers, providing a platform for individuals and businesses to deposit their money and access credit. They earn income primarily from the interest charged on loans, using a portion of the deposits they receive to make these loans. This system is based on the principle of fractional reserve banking, which means that banks are required to hold only a small percentage of their depositors' money as reserves, while the rest is used to provide loans and earn interest. Under normal circumstances, this model works well, as it allows banks to make profits and contribute to economic growth. However, it can also lead to problems when depositors lose confidence in their bank's ability to repay their money, leading to bank runs. A bank run occurs when a large number of depositors simultaneously attempt to withdraw their money from a bank, fearing that the bank will run out of money and be unable to return their deposits. This can be triggered by various factors, such as rumors, financial panic, or news of the bank's financial troubles. This is exactly what occurred with Silicon Valley Bank in 2023. Since banks operate on a fractional reserve basis, they typically don't have enough cash on hand to cover all the deposits they receive. When faced with a sudden surge in withdrawal requests, banks may be forced to liquidate their assets, such as loans and investments, at a loss. This can exacerbate the bank's financial problems, potentially leading to insolvency and bankruptcy. Bank runs can have far-reaching consequences for the broader financial system and the economy. When one bank experiences a run, it can create a domino effect, causing panic to spread to other banks and leading to more bank runs. This can result in a widespread loss of confidence in the financial system, leading to reduced lending, decreased investment, and a slowdown in economic activity. Furthermore, when banks liquidate their assets to meet withdrawal demands, they might be forced to sell them at fire sale prices, causing the value of those assets to decline rapidly. This can lead to a decrease in the overall market value of these assets, negatively impacting other financial institutions and investors who hold similar assets, and potentially triggering a broader financial crisis. To mitigate the risk of bank runs and their potentially devastating consequences, governments and central banks have implemented various measures, including deposit insurance, lender of last resort facilities, and capital requirements. Let's dig into each of these a little further. Deposit insurance schemes are designed to protect depositors by guaranteeing a certain amount of their deposits in the event of a bank failure. By providing a safety net for depositors, deposit insurance can help prevent bank runs by reducing the fear of losing one's savings. This is one of the main purposes of the Federal Deposit Insurance Corporation, or FDIC, which insures deposits up to $250,000 per depositor in the United States. In lender of last resort scenarios, central banks provide emergency loans to banks facing liquidity problems. By assuring banks that they can access funds in times of crisis, central banks can help prevent panic from spreading and avert potential bank runs. Capital requirements are when regulators require banks to maintain a minimum amount of capital relative to their assets. This helps ensure that banks have a sufficient buffer to absorb losses and maintain their solvency, reducing the risk of bank runs caused by concerns over a bank's financial stability. Additionally, regulatory authorities monitor and supervise banks to ensure they are operating in a safe and sound manner. This includes imposing restrictions on the types of investments banks can make, conducting regular stress tests to assess their resilience to adverse economic conditions, and requiring banks to maintain adequate liquidity. These measures can help maintain depositor confidence and reduce the likelihood of bank runs. Ensuring transparency in the banking sector and fostering open communication between banks, regulators, and the public can help prevent bank runs by alleviating fears and reducing the spread of rumors. This can involve banks regularly disclosing their financial information and regulators providing clear guidance on the health and stability of the banking system. Bank runs have played a significant role in several major financial crises throughout history. One of the most notable examples is the Great Depression, which began in 1929 and lasted through the 1930s. During this period, thousands of banks across the United States experienced bank runs, resulting in widespread bank failures, a contraction in credit, and a prolonged economic downturn. Another example is the 2007 to 2008 global financial crisis, during which concerns over the solvency of banks, particularly those exposed to subprime mortgages, led to a series of bank runs. Although the nature of these bank runs differed from traditional bank runs, with many occurring in wholesale funding markets rather than among retail depositors, they nonetheless contributed to the severity of the crisis and the resulting recession. The history of bank runs and their role in financial crises underscores the importance of maintaining a stable and resilient financial system. By understanding the causes and consequences of bank runs, policymakers, regulators, and financial institutions can take proactive steps to prevent them and mitigate their impact on the broader economy. As individuals, it's essential to be informed about the safety and soundness of the banks where we deposit our money, and to understand the protections in place, such as deposit insurance. By staying informed and making sound financial decisions, we can contribute to a more stable and resilient financial system that benefits us all. So there you have it. In this video, we've explored the phenomenon of bank runs, their causes and consequences, and the measures taken to prevent them. We've also looked at the role of bank runs in historical financial crises and the importance of maintaining a stable financial system. By understanding the intricacies of bank runs and the steps taken to mitigate their risks, we can appreciate the critical role that banks play in our economy and the importance of ensuring their stability. The lessons learned from past bank runs serve as a reminder of the need for constant vigilance and proactive measures to safeguard our financial system and promote economic growth. Thank you for joining us on this journey into the world of bank runs. If you found this video informative and engaging, please like, share, and subscribe to How It Works for more insightful content. We look forward to seeing you in our next video.